with our sessions today. But before we go into it, there are only two things in life that are certain. First one is tax. The second one is death. Unfortunately, we can't do anything about death, but we can sure as hell, we can help you plan your taxes. So today, what we're going to do is we're going to go through three main questions that are going to help you with your taxes. Firstly, we're going to look at what is tax. After we understand different type of taxes, we're going to jump to when should you do tax planning. And after going through the tax planning, we're going to go through how to do tax planning. And then finally, we're going to look at a case study. So let's jump into the boring discussion of what exactly is tax. There are direct and indirect taxes, mainly two types. Let's look at them one by one. Direct taxes are taxes paid by taxpayer from the income they earn. So if you are doing a business, you earn revenue, deducting your expenses, whatever profit that is left, you pay corporate tax on it. That is one type of direct tax. In addition to that, we have gift tax, wealth tax, and expenditure tax. These are the example of direct taxes. The reason why these taxes are called direct taxes because they are paid directly by you as a taxpayer, and you can't pass it on to someone else. Now, indirect taxes are the taxes that paid indirectly by individuals. So some of the examples are excise duty, customs, VAT, sales tax, and entry tax. The reason why they're called indirect taxes is, let's take VAT as an example. While the burden of paying VAT falls on the end customer, you as a seller, as a middleman, collect those taxes and pay it back to the government. So businesses are passing these taxes to the end customer. That's why these are called indirect taxes. Now, having the basic understanding, let's look at when should you do tax planning. But before we go into the tax planning, Jen, can you please help launch the poll question? Let's look at a question to understand what everyone think about their tax burden at this point.
I have launched it. Yeah, there. So do you believe that the amount you pay in taxes is too high? Strongly agree, neither agree nor disagree, strongly disagree, or do not know. Let's wait for a few seconds for everyone to vote. So 13 out of 23 has voted. So I think most of them either agree or strongly agrees.
Well, that is in line with actually our understanding as well, that most of the people find their tax burden to be too high, and it's common among all the sellers, all the businesses. Now, then that makes our next topic very relevant, when you should do tax planning. So
there, yeah.
Let's look at when is the right time to do proper tax planning? Well, each case is different. So we need to look at fact and circumstances for each of the business to come up with proper tax planning. But a general, with this slide, we want to just communicate a general rule of thumb, which will give you a high level understanding of when you should start thinking about your taxes. So we divided the business into three different stages. Stage one, when someone is starting a new business, so you've got a business idea, you do not have any sales revenue, you are trying to figure out whether you should run with this business or not. This is the stage classified as stage one. At this point, your business focus should be just running and getting their business up and running, and disregard any tax or tax planning. Second stage is where your business start to become profitable. So our general rule of thumb is, if you are doing a revenue between 50,000 to 100,000 US dollars, you would be meeting direct or indirect tax thresholds in most of the jurisdictions where you are selling. So this would be the right time to look at whether you should start considering which countries you have presence, what are the obligations there, start to give a thought about, okay, can you do something? Do you need to do compliance only, or can you do something more than compliance to bring in some tax benefit? Now, the stage 3 is when your revenues go beyond 100,000 every month, and for your goods and services. So this is the time where you actually get into tax planning. You really need to talk to consultant, or you need to think about how you can save taxes, what kind of tax structure you can use, how you can best optimize your business, where your function people are located, where your business risks are, so that you are in line with all the tax obligations you have, and you have a proper plan to meet all the compliance requirements in the jurisdiction you are operating. So this is, again, this is just a high level rule of thumb in terms of revenue that you can look at to determine which stage you are at, and then start thinking about what sort of planning you need. Now, before we understand the tax planning, let's look at a very hot topic that is impacting most of the Shopify sellers, especially those who are selling into EU. EU has changed their VAT regulations. Starting from 1st July 2021, new regulations come into place, and it created a lot of panic in the market. So before we jump into new regulations, let's take a quick look at what are the old regulations out there. Before 1st July 2021, there was no VAT obligation if your overall sales revenue was between 35 to 100,000 euros, depending on the location you were selling within EU. In addition to that, there was a low value exemption, which means there was no VAT applicable if the value of the goods was less than 22 euros. And for sellers who were selling from who were fulfilling their orders from outside of EU, most of the suppliers were simply declaring the value within 22 euros, and hence they were not subject to any VAT. That's why they were not exposed to, you were not exposed to VAT regulations before 1st July. However, what has changed is after 1st July, low value exemption threshold is eliminated, which means there is no longer a 22 euros threshold applicable. As long as you are selling into EU, VAT would be applicable to you. VAT will be charged at point of sale, which means if you have a store and you are selling into EU, then at the time of sale, you will have to collect VAT from end customer and pay it back to the tax authorities. An example is if you're selling 40 euro goods, then assuming the rate of VAT is 20%, you have to collect $8 VAT and pay it back to the authorities. Now, there is a monthly or quarterly compliance obligation depending on the location for sellers who are based outside of EU. If you're running your store from outside of EU, IOSS is the way to go for you, and there will be monthly compliance. For sellers based within EU, they have to register with OSS and do quarterly compliance. In addition to this, EU has defined in the regulation low value of goods threshold. They set it at 150. So as long as value of goods is less than 150 euros, you fall within these, you can still use IOSS channel to fulfill your VAT obligations. Now, what is the impact of new regulations is that if you don't, let's take a look at if you don't comply, if you don't register with IOSS, what are the options out there? So then your packages can still go into, can still be shipped to the customer, but then the customer need to pay VAT. So if you are sending your package without IOSS number, there would be a possible delay at custom clearance. Secondly, the end customer would require to pay VAT. Another alternative that is provided by some of the suppliers, especially those based in China, suppliers are usually offering their own VAT number. However, this does not discharge your liability as a Shopify seller at the point of sale. So supplier will, in this in this supplier VAT scenario, supplier is using his own VAT number, which means they are declaring that they are the one who are selling it to end customer. However, as a Shopify seller, you are actually the one who is selling to end customers. So therefore, this kind of arrangement is not exactly legal. Now, if you don't do these compliance with the VAT regulations, two things gonna happen. It's gonna, if customer need to pay VAT at the end, it's gonna increase the chargeback rate. And if there's an increase in chargeback rate, then PayPal, Stripe, Shopify, or other payment gateways gonna start shutting down your accounts, which means this gonna lead to negative impact on your business, and potentially it could kill your business in the long run. So these are the high-level summary of VAT EU regulation. Now we look at the next topic. We talk about what is tax, when you should do tax planning. Now look at how to do tax planning. So there are two ways of doing it. You can do it yourself, or you can do it through a consultant. Now, if you want to do it yourself, you have to understand a lot of things. Firstly, the first one is very easy one. Given that e-commerce is your business, you do understand your e-commerce business very well. Now, in addition to this, you need to read and understand regulations of all different jurisdictions. And the jurisdiction you are operating, you need to make sure that you have an understanding of the tax system there. In addition to that, with your home country from where you make sales, you need to understand if there is a double tax treaty network. So once you have this understanding, you need to understand if there are tax deadlines and filing obligation in all the jurisdiction that you operate. After understanding that, you need to understand how to file different tax returns and file them with relevant tax authorities. And in addition to that, you need to have an understanding of the penalties associated with wrong or late filing. So this sounds like a hell lot of work, and there's an easier way to deal with it, is just to find a consultant. Now the question becomes what sort of consultant you should engage to do this, this type of work for you. So you just need to find a consultant who actually understands e-com business. So most of the consultants in the market, although they are consultants, they might not be very familiar with the unique nature of e-com businesses. So you just need to make sure you find someone who is familiar with e-commerce business, who understands the challenging international tax environment, who is aware of your operations in different jurisdictions and how it creates permanent establishment risk, especially if you have employees scattered around the world. And then finally, on top, the consultant should be on top of regulatory developments, such as digital taxation, the minimum tax that is coming in, tax haven, scrutiny for tax haven location like Dubai, BVI. So your tax consultant should be very familiar with all these regulations so that they can help you plan better. Now we look at how to do tax planning, and both methods you can either do it yourself or you can find a consultant to do it for you. The last part of this quick presentation is to look at a case study where we had a client who did the tax planning by himself and then eventually came to us and we helped him plan his taxes. And let's look at when he does his planning by himself, what did he do? And how is it different from when he engaged a consultant to do his planning? So he started his business with a US LLC. He opened his bank account. He opened his US PayPal, and then he opened his US Stripe account. He has a bunch of websites that were registered under this US LLC. He started operating his business with US LLC. After a little while, he did his research, and he found out that it's easier to have a Hong Kong PayPal account because you are given more benefits and is a bit more beneficial, and in terms of limit and different parts that he wanted to use. So he came to Hong Kong and opened a Hong Kong company, got a bank account, set up a PayPal, and then set up a Stripe account and moved some of his websites under Hong Kong company. Now he started booking his revenue in both Hong Kong and US. Some of the expenses were paid from Hong Kong entity. Some were paid from US entity. There were intercompany transactions between Hong Kong and US. So whenever he needed money in US LLC, he just transferred money from Hong Kong entity to US and just use it to pay supplier or pay the marketing companies. With this arrangement, given that there was no segregation, no proper planning around it, although the idea was very good that you set up a Hong Kong entity, you have a US LLC, then you can have a better business control and you can diversify your locations. But he ended up paying 21% tax in US LLC and then 16.5% tax in Hong Kong. So overall, his tax bill was 37.5%. And he was given that he was randomly transferring income from Hong Kong to US when he needed it and vice versa. So some of the income was double taxed in either Hong Kong or in US. Now, next thing to look at is how did we help him clean it up? So we started with moving his US LLC stores. We move all the stores under Hong Kong entity. Given that he was a non-US citizen, we don't see a bigger benefit. So after discussion, he agreed that he does not want to rely on US LLC anymore. So all the stores were moved to Hong Kong entity. Now all the revenue and expenses were booked under one Hong Kong entity. We ended up closing down his US LLC, and finally, we filed an offshore claim under his Hong Kong entity, which resulted in 0% tax for his Hong Kong entity. So overall, on net basis, he ended up paying 0% tax. So this hopefully help you understand how the different, when you do tax planning, the things you need to take a look at, and things you need to consider before you move into implementing the structure. And another thing to keep in mind is that taxes usually come after the year end, and usually when the year ends after 12 months, you need to file a return, and it takes another 8 to 9 months to file a return before you receive your tax bill. So, which means that you need to budget your taxes at the start of the year so that you have enough cash flow to pay your taxes at the end. So that's pretty much the whole quick presentation on different tax strategies. What is taxes? Who should do tax planning, and when we should do tax planning. And let's look at then the questions and see what you want to ask, and then we can go from there.
And I like this quote: the man who asks a question is a fool for a minute, and the man who does not ask is a fool for life. I will remember this. And with that, we have our first question from John.the1. Okay, he is the one who will ask the first question. So the question is, how long does it take to get your tax saving solutions? And as an existing Shopify seller, do I need to create new store to use your tax structure?
So the tax solution really depends on the business itself, where you are at in your business. So for example, if you are already operating an existing structure, then we need to look at which location you are at, which countries you are selling into, and then what can be done to modify the structure. So it normally takes around 2 to 3 months to plan around it and execute a new structure and move your stores, because when you are moving to a new structure, it might cause some sort of business interruption. So you need to probably for some time run 2 parallel structures before you can switch to the new one and then ditch the existing one if that is not tax beneficial.
Okay, thank you, Tayeb. We have another question from Cameron Walker. My understanding is that if he has no establishment in the US LLC should be tax-free. No ETB US.
He was also selling into the US market as well. So therefore he was, if you are selling within US market, then you are subject to tax. So that's why he needed to pay taxes there.
Okay, got that. Okay, we have a question from Raj. I am a Singapore-based SME selling on Shopify. What is your advice if we want to expand our e-commerce business beyond Singapore, US, UK, EU, etc.?
I think you should put your business plan first. Think about which markets you want to expand and what kind of payment processes you want to use, which locations are beneficial to you, and starting from there. So once you have your business plan ready, then start expanding into those markets. And then once you hit the revenue thresholds of, for example, within EU, if you are selling around 80 to 100,000, that's where you need to start looking at if you can have some sort of tax savings. For now, you can use your Singapore entity and expand into all these markets. But when these markets become sizable for you, then you can start looking at how you should plan around it.
Okay, thank you, Tayeb. So we have a question from Cameron. If you are an HK company with offshore status with sales around the world, are your clients paying business tax, not VAT, to their sales countries around the world?
I think we are mixing two things here. So the clients that need to pay VAT is the obligation based on the jurisdiction. So for example, if a Hong Kong company is selling into EU, we are talking about indirect tax there. So which means the VAT. So if you are making sales to a Hong Kong company is making sales to EU customer, you have to collect VAT from your customer and pay it back to the EU tax authorities through IOSS. That's one thing. Second thing we're talking about is the business tax or the corporate tax. That is different from VAT. So all your business profits that you're going to book, depending on if you are running business within Hong Kong or not, you can use this offshore. If you are not making any purchases and sales within Hong Kong, you can use this offshore claim. And if Hong Kong government, Hong Kong tax authorities approve it, then you would have zero tax on it. Then the question becomes, who should pay taxes? Then the answer for that would be where the owners are located. If there is a repatriation back to the owners, then they need to pay tax in that location.
I see. All right. Thank you, Tayeb. We have a question. HK company does not have to pay US income tax to IRS.
Generally, each country, a simple answer to this is generally each country and each location have tax obligation to that particular country, unless you have a permanent establishment in another jurisdiction. So in this case, US, if you have a permanent Hong Kong company has employees sitting in US and running their business from US, then there would be tax implication that need to look at. Well, this really need to, so if you open US LLC due to tax treaties between countries, if there's any option. So it's really going to get down into looking at the tax treaty network. And if there is a treaty network in place, then you can take, generally, you should be able to get exemption under the tax treaties. So there shouldn't be any double taxation.
Okay. And then we have a question again from an anonymous attendee. Hi, are you able to help to start Hong Kong company and that way some part of quote unquote tax help on our company sales? Because we are a Thai-based company, mostly selling Amazon FBA, which create tax nexus on most of states in USA. So now when selling US from Shopify, we ship from Thailand. We should also collect and submit US sales taxes, which goes really complicated and super expensive. Thanks for your advice.
So this is a very specific case, which we really need to look into the detail before we come up with the advice. And we need to, I mean, at the top of my head, I can't say anything that can be done here. But if you are having inventory in US and then you are selling through Amazon, Amazon already collects sales tax from you. And those are some of the limitations from for the FBA sellers. So, and then you need to comply with all the, of course, when you sell into US, you need to comply with all the sales tax regulation in US. So unfortunately, at this point, I don't have any advice, but you can write it to us, and we can look into the details of this and see what we can do to help you out.
That's right. Okay. Thank you, Taib. Any recent changes in US importation rules like the EU?
We are not aware of any changes that US have in terms of importation regulation.
Mhm. Okay. And then a question from Mahavir. Can you explain the concept of permanent establishment within the e-commerce industry?
Sure. So when you are running your business in e-commerce, for example, if you, let's take an example, you are based in Singapore, then you have employees in US, you have employees in China, you have employees in Hong Kong. Then all these employees, if they are performing value-added activities for your business, then you have a permanent establishment there, which means you have a taxable presence in those locations. The reason why it's this case is that these people are performing activities, for example, based in US, so that you can generate revenue. So you are generating revenue by utilizing the personnel in US who are your employees. So part of your income should be booked in US and you should pay tax to US tax authorities. So that is the concept of permanent establishment.
Okay. And then a question from Raj. How can they contact you for a free consultation?
You can go to the GetFreeTax.com website and book a consultation from there.
Okay, thank you. Okay, we also have some questions from the chat box. Singapore tax for e-commerce. Can you explain?
Singapore tax for e-commerce for the business tax should be 17% that you need to pay if you are a Singapore entity.
Okay, got that. And then how about for Netherlands citizen? Does your structure works?
Really depend on the facts and circumstances of the business. So we need to understand more details of if you are although you are an EU citizen, we need to understand where your business is. But if you are a Shopify business, where you're running your business from, so at a corporate level, we should be able to help you minimize your taxes.
Okay. And then one of our attendees is asking if you can run through the US importation rules like you did for the EU.
I am not the expert in US importation regulation. Those are the details that are picked up and analyzed by the VAT indirect tax expert. So you will probably have to talk to an indirect tax expert on it.
Okay, thank you for that. Okay, there's a follow-up question. I don't have an employee in the US, only LLC. With Amazon FBA, am I deemed having permanent establishment with the income generated from Amazon FBA?
If you do not have any employees and you're just selling into US, you shouldn't be, it's likely that you are not creating any permanent establishment in US.
I have a question again. Selling in EU with HK company using Amazon FBA. So do I have income tax liability to UK EU?
So selling into EU with using Amazon, do I have income tax liability? You have a VAT regulations are applicable to you. So you need to charge VAT to your customer and pay it back to the authorities. So you need to get a registration. Since you are a Hong Kong company, you need to get a registration with IOSS, and there's a monthly compliance requirement, which means you need to file return on monthly basis and then pay the tax on monthly basis.
Okay. And then we have a question from John. What is the monthly revenue that the best time to get in touch with GetFreeTax?
If you are doing anything around 80 to 100,000 USDs a month, that would be a good time to start looking at your taxes, and that would be the time that you get in touch with us, and we will be able to help you navigate in the complicated tax environment.
Okay. Thank you, Taib.
So the first one is on only VAT. I already have that. IOSS cannot claim input VAT taxes. We need to have a separate discussion on the details of VAT. and how to navigate in this environment when you are using IOSS and you are exporting from outside of EU. Sorry, you are importing in EU out from outside of EU, then you cannot claim any deductions or any credits. So from Indonesia, have LLC in Wyoming. My employee is based in PH in Indonesia, but I sell to EU. You need to make an assessment of your first US LLC. And then if your employees are based in Philippines and Indonesia, then you probably have a taxable presence in Philippines and Indonesia as well. So you need to look at what sort of taxable presence you have and what kind of activities are performed by employees in Philippines and Indonesia before we can determine what exactly would be the tax obligation in each location. Sorry, what was the last part of the question?
Oh, sorry.
And then you have, but I sell to EU and US. Yeah, for when you are selling to EU, of course, indirect tax VAT is applicable to you, and US I already answered for you. So yeah, you need to look at 3 locations: US, Philippines, and Indonesia to determine your activities, and then that would determine where you should be paying taxes.
Okay. Thank you. A lot of questions from our attendees today. That's very great. Okay. We have a question from Sophia. Conventional VAT or IOSS is better economy setting for HK sellers?
Well, the choices are not determined based on, you do not have this kind of choice. So it really depends on the nature of the business. So for example, for IOSS, if you are selling from outside of EU, like in your example, you are a Hong Kong seller. If you're a Hong Kong seller, you are selling into EU, then and if the value of the goods is less than 150 euros, then you can register with IOSS through an intermediary. Now, if your value of the goods is more than 150 euros, you cannot register with IOSS. You need to go with OSS scheme, and then you need to get the, or if you need to get the numbers and do the quarterly filing with that. I hope that helped you clarify this.
Thank you, Tayeb.